Hi, people. The worksheet that you see here is taken from exercise 4B5 or something similar to it in Chapter 4. And I wanted to show you the completed worksheet as it's completely spread out. Of course, they started out with an unadjusted trial balance. They prepared for simple adjustments, as you can see. Debit, credit, debit, credit, debit, credit, debit, credit. Then they extended the adjusted trial balance, which you have done in your previous homework. And what's normally done is that the adjusted data gets spread out according to where it goes or what financial statement it goes on. For example, the cash asset to the balance sheet, accounts receivable asset to the balance sheet, prepaid insurance asset to the balance sheet. And when you're working these problems out, that's what you would be doing. You'd be carrying the account balances according to what financial statement they would appear on. Store equipment is an asset which would go to the balance sheet. Accumulated depreciation, is a contra asset, and when you do your statements, it's going to be subtracted against that 28, as we've explained. And the accounts payable is a liability, as the capital account is a balance sheet item insofar that the ending balance gets posted there. But for now, we take that figure and carry it over there. There were a couple of dollars worth of withdrawals, which follows the owner's equity account. Okay, and then the revenues, as you can see, they start down here, $38, and then the expenses are carried across, right, from the adjusted trial balance. Again, we're going from here to here, here to here, here to here, here to, according to what statements the accounts will appear on. So there's your income statement items, revenue. There's your expense items, rent, wages, depreciation, insurance expense, store supplies expense, and they all are expenses. Then at the bottom we get the total of the debit and credit column. If there are more credits than debits, that means that the revenues are in excess of the expenses, which would produce a $12 net income. And we subtract to prove and then add to finish off the bottom. We subtract to calculate, and then we add back the profit to the subtotal there to just arithmetically prove that's the case. And of course the same is true in the balance sheet. I've explained before. Now these are not income statements or balance sheets per se, but they provide the accountant a basis for very easily transferring the data to the appropriate financial statement. It could be done directly from the adjusted trial balance. And if we just back up, the whole adjusting process in an automated system can be just keyed into the computer as normal journal entries. Although they'd be classified as adjusting entries and described as such, so that you could just key these guys into your computer, debit, credit, debit, credit, debit, credit, and then click post or click enter, and have your ledger actually show all of these adjusted trial balance. Then you could go to another menu, which would ask you to choose what you want to see, an income statement, an equity statement, and a balance sheet. So this whole process could be automated, but I like to show you the what's under the hood in terms of the process by which the programmer had to follow in order to get the numbers to the right places. Okay, so that if I was going to prepare an income statement, I would chase down the revenues, and that's where they go on the income statement. And I see the account here, revenue from clients, so I'd click on that. Okay, and I'd enter the a $38 number, so I'd enter the $38 number right there, and then I'd come down to the operating expenses, and I have wages, depreciation, insurance, store supplies. So it looks like I have 1, 2, 3, 4, 5. I have 5 expenses. Again, rent, wages. So we'll list them out as we find them. Rent is, let's make sure we get it right, is a $4 debit. So we'll put a $4 debit in there. And the next one down is the wages, which is 16. So we'd select here, wages, expense, put the 16 in here. Next one is depreciation on the store equipment. That's $2. So we'd click and come down and chase down that depreciation expense. Here it is. Okay, and what did we say that was? $2. All right, so we'll stick that in there, and then after we have the insurance, the store supplies, and that's it. The insurance expense and the store supplies expense. So we'll get them. Those guys in here. The insurance expense is not the prepaid, that's an asset. Where is the insurance expense? Up here, okay? So we'll get the insurance expense in there, and that is another $2, so we'll pop that in. That's $2 there. Then the final expense is the store supplies expense, so we'll chase that down. Here it is right there, and that is... where are we here? Store supplies expense, another $2. Okay, there. Exercise in twos. Okay, then we have to add and get the total operating expenses, which we know is the same as this column here. 4, 16, 2, 2, and 2 equals 26. 4, 16, 2, 2, and 2 equals the same as the total that you see on the worksheet income statement debit column. So again, we'll take the revenue minus the expense. That's your income statement. That's your income statement template, and you can see the formula R minus E, revenue minus expense. Excess of revenue over expense proves to be a net income or a net profit. And that is already plugged in over here, so you already know what it is. So we'll just put the $12 down there, and away we go. Okay, now we're ready to prepare our statement of owner's equity. Oh, so I checked the answer, and apparently I got it right. Now it wants to go to the next, I guess I have to click OK. And then immediately it brings me to the next field where I have to prepare my statement of owner's equity. So as you've seen, you've got to take the beginning balance of capital, which is $12. You can see it's right out there. So I'll take my $12, and what you have to do is add your net income. And again, there's a menu selection here for you. Net income, which we already know, is $12. So we'll add that $12 in there. And then the withdrawals we see is $2. So that's, of course, going to be, the withdrawals is going to be a $2 reduction from the increase. And we still have an increase in capital. Obviously, if there was a profit of 12, and the owner took out for personal use 2, then there's a $10 increase from the beginning balance to the ending balance, which would be a total of 12 plus 10, and that would be the ending balance. As you can see, it's dated, so it's intuitive that you can see the beginning and finally the ending balance. After we've added the profit and subtracted the withdrawals, we've increased the 12 by 10 to get to the final balance. So you'd add the 10 to the 12. Okay, so that's going to give you the 22 or the 32. Okay, check that. No, 22. What am I talking about? Okay, so we're good. But let's just check to make sure I didn't goof it up. I'm good. Click OK. and finally go to your balance sheet, where you're going to have your assets. So you got 8537, 28 minus 12. So let's move right along. You got your cash first. So we click on that, 12. Then you get the next item is your accounts receivable. That's money that's owed to you. That's an asset to the balance sheet. The cash was 8, right? 8, and then the accounts receivable is what? 5. So we stick the 5 in there. The next asset down is prepaid insurance. Okay, you see, cash, accounts receivable, prepaid insurance, then store equipment. So let's get the prepaid insurance in there. That's $3. So we'll put the $3 in there. And then what we have to do is, let's see, we also have store supplies for $7. All right, so we will put in the store supplies right over here. And I said that was what, $7, right? Notice how it got reduced from the 9. Subtracted the 2 for the adjustment. The same thing with the prepaid insurance, that went down. And you know that the accumulated depreciation went up from 10 to 12. So that when we list this equipment out, which we're about to do, where is it? Store equipment, right there. So when we list out the store equipment, we list it out at the original cost. It gets carried right across as $28, so that we'll put the 28 there. And I want to show you that the contra asset, accumulated depreciation, is in fact subtracted, and that is now $12, so that you have 28 minus 12. The credit offsets the debit, and it follows that logic when we go to the balance sheet, whereby we subtract the 12 from the 28 to show what we call the book value of the asset after having subtracted $12 from the original cost of 28. There's actually $16 left of the asset that still has to be written off over the remaining part of its useful life. So then we have to, once we have those assets listed, we have to add them up and get total assets. Okay, I had forgotten to put the 7 in there, which I did. So we just add these guys up. Excuse me. 8, 5, 13, 3, 16, and 7 is 23, and 16 would be $39. And that would be your total assets on the asset side of the balance sheet. I guess they're prompting me to check the answer there. I hope I got it right. So let's see what happens. Okay. So I clicked, and job well done. And I think it's going to take me to the other side of the balance sheet, which is going to show you the liabilities and the ending owner's equity. So here we are. We've got the asset side all set. Let me move this over. All right, kids. So the liabilities consist of, looking at the worksheet, I see accounts payable of $10. So we're going to get that in there. Accounts payable, $10. Okay, get that in there. And then don't forget, down the bottom, you just brought on, from the adjusting entry, you brought on that $7. So you got to get that accounts, wages payable in there, which was developed from the adjusting process, and there it shows in the balance sheet credit column, so that we have to deploy it, so to speak, here to come up with the total liabilities, which simply is $17. And now the owner's equity is a piece of cake. And we're just going to show J. Tanyan Capital. We've already developed it from preparing the statement of owner's equity. So there's your $22 that you just simply pick up from here and pop it in over here. So put in your $22, and then you're going to be adding, hopefully, and it looks good to me, if I've got 39 over here and add the liabilities plus the owner's equity, I'm going to get the $39 over there, and I bet we got it right. And again, what are you back to? You're back to your accounting equation, aren't you? A, assets equals L plus OE. Assets, the claims to the assets are by creditors that claim 17 of the 39, and the owner has equity to the other 22, making up the sum. If you did not know the owner's equity, right, let me just show you. If I took that out of there, right, if I took that out of there, the other way to get owner's equity, you can probably recall, is simply to do the formula A minus L. So whatever is left after the creditor's claim has to be the owner's claim. 39 minus 17 equals 22. Okay, so I think we're good, and I'll check the answer, and I would use this to help you. It's going to apply in Chapter 5 as well. Thanks for watching. Spread the news that these might be helpful. Thank you. Good job.